And it's 1:30 p.m. right here in Lagos, Nigeria. Coming up, Egypt's annual inflation rate drops to 31.5% in April, marking the first decrease in almost a year. And Kenya's finance bills left out alcohol and cigarettes from excise duty adjustment for the first time in 5 years. Plus, global markets brace for U.S. April CPI data. Hello, welcome to the program. Let's get a check on the markets now, starting on the African continent. We see it's mostly negative sentiment right here with the NGX down marginally 0.06% after closing positive marginally yesterday. South Africa's index, that's also down 0.28%. Other markets we track, in North Africa, we see it's just the EGX 30 in the green, up 0.33% at intraday, and we see Kenya closing negative yesterday. That was down 1.46%. Big drop there for the Kenya index. Let's move on to the Middle East. See, it's mostly mixed sentiment right there with the Abu Dhabi index unchanged, but positively 0.00%. Dubai index, that's up marginally by 0.06%. In Saudi Arabia, though, it's a different picture, down 0.54%. The Qatari index, that's also down marginally 0.03%. Let's get a check on Europe now. We know cash used to be king, but study after study has shown that fewer people actually want to bother about cash. Germany's biggest bank has stopped even giving out cash at this time. Let's talk to Lars Holter in Berlin. Great to have you, Lars. So right now, we're seeing that most of these banks moving away from giving out cash. What's happening there?
Yes, thanks for having me. Well, we're talking about Deutsche Bank, and indeed, they are no longer handing out cash at the counter. The move angered customers, even though cash is obviously still available at the bank's ATMs. What really made people angry, likely the fear that not only Deutsche Bank, but our society in general is moving towards a cashless future. And that's something studies have shown for a long time, but it's a problem, especially for older people. Here's some new numbers that just came out. More than a third of Gen Z consumers, that's people between 15 and 30 years old, said that they would shop exclusively in stores that accept cashless payment. They would rather not buy a certain item than bothering with bills and coins. To compare that to the older generation, only 14% of boomers, that's 60 to 75-year-olds, insist on options other than cash. That means stores are now risking to lose customers if they don't comply and get into cashless, which of course these days is not just about widespread options like credit cards, but it also includes fully digital payments like Apple Pay, or people paying with a wristwatch, with crypto, or maybe even with apps that use QR codes.
How big is cash these days in Europe?
Well, cash is still the most widely used form of payment, even though it's declining. The European Central Bank says that cash was used for 59% of point-of-sale transactions in 2022, and that is down from 72% just a few years earlier. According to the ECB, cash is most often used for small value payments in stores and for person-to-person transactions. But the ECB sees a clear shift in momentum, and it does have something to do with the pandemic. During the pandemic, of course, use of cash was discouraged to eliminate just another way of transferring germs. But with some people, those digital habits stuck. Contactless form of payment, whether that is credit card or wristwatch, are now making up a larger part of all transactions, and they're the fastest growing segment here. By the way, the numbers are similar for the UK and Switzerland and some other countries outside the ECB system.
But what are the corporations saying about this? Are they on board?
Most companies have been on board for a while now, not least because of the clear advantages it presents. Of course, accepting a more diverse array of payment options makes you more attractive to the customer. But there's more. Just think of any little corner store. Less cash means less risk of theft. It means more automated bookkeeping, which in turn saves money too. But, and that's especially true for Germany, cash will remain important for a long time. Germans have generally been slower to adapt to other payment forms, and they have an almost emotional bond to bills and coins. The electronics retailer Gravis saw that earlier this year when it issued a complete ban on cash for any transactions here in Germany. That made headlines throughout the country, and a large number of retailers found it necessary to assure their customers that they wouldn't follow suit. For most of them, of course, it also wouldn't make much sense. It wouldn't be attractive to forgo cash. For Gravis, it's a different story. That company is all about tech. It's an Apple retail partner, so no wonder that company would be a tech outlier here.
Yeah, maybe, just maybe cash will be king anymore going forward. Thank you so much, Lars Halter, right there in Berlin. Let's move on to the UK now. Have Juliana join us right now. Great to have you. So we see Jackstock Festival, a much-loved festival on Dartmoor, has been cancelled this summer. Is it a cost of living crisis?
Good afternoon, Laddie. I don't know if I'm going to be showing my age here, but I've got to confess, until I received your email a couple of hours ago, I hadn't actually heard of this festival. And I think, sadly, for the organisers, that's probably one of the reasons why they've cancelled it. I did see that they've posted on social media apologising to the hundreds of people that had purchased tickets, that due to a slowing down of ticket sales, plus, of course, the cost of living crisis, which is being blamed for most things here in the UK, they are cancelling the festival. I've never heard of it. I'm not sure our viewers have, but it is a festival that apparently has been going for about 12 years. It was to take place in the summer over a weekend, but alas, it's been cancelled. I've got to say, though, Laddie, don't worry. Don't cancel your ticket to London just yet, because, of course, there are other festivals taking place, most notably Notting Hill Carnival. Is it a festival? Is it a carnival? Pretty much a festival, really, considering it has over 1 million people flocking to the British capital. So, yes, keep your ticket alive. Don't cancel it. You can still come to London, but just sadly not for Dartmouth, I'm afraid. That's been cancelled, Laddie.
Yeah,
but there are many other events you can attend.
Yeah, many other festivals to go to still, even though the crisis is still biting hard right there. But the energy regulator, Ofgem, the next energy price cap announcement, that's coming up 26th of May. What should we expect?
Yeah, there's a pretty significant story, actually. And according to the Cornwall consultancy firm, which basically have garnered a reputation over the years for being pretty accurate with the energy regulators' readings, they say that they're expecting the energy regulator to drop the price cap from where it currently is, which is quite confusing because, of course, it's been cut and carved about by the British government. So basically, 4 times a year, Ofgem, which is the energy regulator, they look at how much it's costing for gas and electricity to be distributed in the country. They do this for about 80% of those who use gas and electricity. And before, there was never an issue, before the pandemic and before the war in Ukraine, because it very, very rarely moved. Of course, that's not been the case. As pre-pandemic, we were at about just under £2,000 a year. We're currently at about £3,280 a year. But one success of the Liz Truss 6-week administration is that she was successfully able to put the energy price guarantee. So at the moment, nobody in the UK, unless you're a big business, is paying more than £2,500 a year for their gas and electricity, despite the fact that the cap is at £3,200. And now, according to the consultancy firm, they believe that because of the fact that we're getting warmer summers and for the fact that gas storage has been pretty successful, they think that the price cap will fall from £3,200 to about £2,800, essentially knocking off about £400 a year on people's bills. This is going to be a huge announcement if indeed it is going to be accurate. We'll have to wait and see what the regulator comes up with on the 26th or the 24th of this month. But this is a good news story, and it is going to accommodate the time between July and September. So yes, we're all holding our breaths and keeping our fingers crossed, because one of the reasons why inflation is stubbornly at double digits, 10.1%, is because energy is so expensive. So if that comes down, we might start seeing a trickling down of CPI.
And it's also great that we see cost of energy and oil prices actually coming down at this time. So that might be feeding to all of that. But how are the markets looking at intraday in the UK?
Not great, actually. As we discussed this time yesterday, Laddie, we're all awaiting that US CPI data. I believe inflation currently at about 5% in America. Gosh, less than half of what we've got here in the UK, but still affecting people. We know that interest rates are a top topic of discussion for central bankers across the world, and that has affected the mood of investors in the UK as they await that CPI data from the US. We're not expecting inflation to have moved much. I believe it moved about 0.4% in Feb, followed by 0.5% in March. What are we going to get for April? The UK blue chip index is in red, awaiting that decision. So the all share is down 0.21% at intraday. The FTSE 100 down to at 0.23%, and the FTSE 250 is down 0.16%. In the currencies market, the British pound is currently trading up against the US dollar by 0.01%, up to against the euro by 0.06%, but down against the Japanese yen by 0.08%. Sad to say that unfortunately none of that data is going to bring back that festival you were hoping to attend, Laddie, I'm afraid.
Well, I guess that's how it's going to be. But there's still the Notting Hill Carnival coming up, so that's great. Thank you so much, Juliana. All right, now let's take a look at other markets now. See what's happening with Asia there. We'll see it's also down right there in Asia, mostly red. All eyes on that CPI data from the US. Investors trying to position for whatever comes with that data for April. ASX down 0.12%. The Nikkei 225, 29,122 points, also down 0.41%. Kospi there down 0.54%. Be watching out for that CPI data coming out from the US, see how markets actually react to that. Let's see what's happening in the US now. See stock futures also pointing downward right now, 0.13%. For the Dow Jones Industrial Average futures there, 0.13% down. S&P 500, that's down 0.17%. And tech-heavy Nasdaq's down 0.24%. Still waiting on that April CPI data. Let's get a summary of yesterday's close from our correspondent, Maria Bird.
A dip on Tuesday as the Dow Jones was down by 0.64%. The S&P 500 down by 0.74%, and the heavy tech Nasdaq closed the day at 0.63% down. Many investors are watching to see the outcome of President Biden and Congressman McCarthy's meeting, as Congress has had a bit of a stalemate as it relates to increasing the debt ceiling of $31 trillion. This increase could be the highest the U.S. has seen in recent years. It is going to be critical and key that this happens before June the 1st, as the U.S. may not have much cash flow after the 1st of June. Investors are also watching to see what's happening with the banking system, as banks are beginning to tighten on its lending. This is all a result of what is expected to be an inflation rate report on Wednesday, and potentially inflation could show up to 5% increase over a year ago. This could mean some major challenges for the U.S. and potential recession. This is also going to have an impact on the Federal Reserve's potential increase on interest rates. This U.S. economy is definitely seeing some major challenges over the past few weeks, but the coming days will allow the U.S. to see what the future will have ahead.
That's our correspondent, Maria Bird, giving us a summary of yesterday's close on the U.S. markets. Now, we'll take a break now. When we come back, we'll get a sense of what role crypto exchanges will play as countries maul crypto taxes. That's our next conversation. Just stay with us. Welcome back. Well, according to a report on crypto regulation in Africa by CVVC, African countries are showing diverse responses to the acceptance of cryptocurrency, and there's increasing consideration about the use of crypto on the continent. And most countries are mauling tax on crypto activities. Countries leading those talks include Kenya and South Africa and Nigeria. But what role will crypto exchanges play in all of this? Joining me now is Peter Mura, Marketing Director at Yellow Card Financial. Great to have you on the show.
Appreciate it.
So with the rise of crypto tax proposals by countries like Kenya, Nigeria, South Africa, what role will crypto exchanges play in making taxing crypto a reality?
See, the number one thing is crypto exchanges are the number one place where or people will have access to crypto, right? So for us, we're the ones to make taxing crypto a reality through working with governments, and also we really understand the importance of following the regulatory frameworks and also being compliant in the industry. So us as Yellow Card, we have collaborated actively with many governments across Africa to enhance the crypto regulations and also to ensure just proper taxation. And I think the other key role we play as crypto exchanges really too is to have a robust KYC and also following the clear anti-money laundering. So KYC is know your customer and anti-money laundering procedures, really which help in identifying users and preventing fraud or illicit activities. And that allows us really to be really transparent and being able to have a comprehensive records of our transaction, including user information. And I think additionally at Yellow Card, we really have a strong emphasis on education. So we believe that when we foster education in the crypto industry, we will allow the adoption to grow even faster in Africa. We're in about 16 countries, which really allows us to really push. And we have different platforms, including Yellow Card Academy, which allows for that type of education. So through educational initiatives, we will empower users to really understand the complexities of the cryptocurrency market and perhaps any new regulations that come up.
We know, most of the investors, they love this market because of all the, incredible gains, they get for it. But do you think taxes will discourage crypto investors going forward?
No, I think that there has to be a balance, right? At the end of the day, and one of the biggest things we appreciate about taxation, which is something I, as an investor as well would speak about, is for us it will allow for better collaboration with different payment providers. One of the biggest ways we know in Africa customers transact is through mobile money, right? And those are the spaces where we want to be and allow customers to easily move money in and out of our crypto exchanges. So with taxation, it allows for more visibility, not only for the government, but also for the industry as a whole, to be able to allow and accept crypto as a form of payment. I think you just mentioned in another segment how people in Europe, people use even crypto to pay, right? So the biggest thing with taxation from a crypto exchange perspective is allowing people to move money in and out. Also for the customer, it makes it easier for them. Yes, it might introduce some operational and compliance requirements, but I think it's really important, just like any other business right now and how recognized they are, to have some form of taxation, because it is an asset at the end of the day. As a customer is gaining from it, just like any other property you may have. So I think it will not have a big issue in terms of the market, but it just really, as I mentioned before, have a lot of education in what this means for you. And I think for us as Yellow Card, we will try and make it as easy as possible for the customers.
And how much impact do you think taxes will have on your business, your profits, going forward? And are you going to pass, some of that burden to the customers in fees?
The beauty of crypto in itself, it really allows for, how would I say, less interaction with fiat, which is like a hard currency, right? Which inevitably makes any transaction on the crypto exchanges much more cheaper than a normal transaction, right, in the normal bank. So we will do our best, obviously, not to transfer all the costs to the customers. And if we do, just like we do in our platform, there'll be clear, I would say, breakdown of the prices, of the price, of the tax implication, and a lot of communication with the customers to understand this is what is happening in your market and these are the things we require. Because once that happens for them, then it becomes easier for them to buy things like anywhere they are using crypto and using what they have in their wallet. So it will be a win-win. I will make sure we do our best to absorb, and when we can't, we will definitely communicate any changes. But at the end of the day, if the government requires us to do it, we will do it and carry our customers along.
And what do you think about most of these tax plans that we're seeing in Europe is about 27%. Kenya is talking about 3%. Do you think these percentages are too much? Will it stifle innovation going forward?
Good question. It wouldn't. For me, you have to strike a really right balance between taxation and fostering innovation. And this is very crucial, because if you have excessive tax plans, then obviously innovation will be stifled and the growth and the adoption becomes slower. So it's important to note that tax regulations are evolving in Africa, and also through our partnership with governments, really, the governments must also seek to understand and adapt the unique challenges, because crypto is very different from other assets as much as there's gain to it. And I think I mentioned earlier, we really engage constructively with governments and regulators in across different countries, like in Botswana, in Zambia. We really collaborate with them. We allow them to see what we are doing and show them the growth and show them potential of what crypto can bring. I think as you look at, we really advocate for sensible and balanced tax plans. And really, we want to aim to foster an environment that encourages innovation and really responsible crypto adoption in Africa. So we are very committed to driving growth in the crypto system, in the continent as well, through education and collaboration, and through a really seamless and user-friendly platform. So we are part of the growth, part of the change, and will continue allowing for this to grow and become as big as it is in Africa.
All right, still early days for regulation in that industry. We'll see how it develops going forward. Thank you so much, Peter Moreau, Marketing Director, Yellow Card Financial. Thank you.
Thank you.
All right, let's take a look at what's happening in North Africa. Now, we see Egypt's annual inflation rate dropped to 31.5% in April, down from above 33% in March, marking the first decrease in almost a year. Figure, however, remains significantly higher than the 14.9% recorded in March 2022. According to data released by the Central Agency for Public Mobilization and Statistics, we'll see that while the annual inflation rate has decreased, the monthly headline inflation rate continued to accelerate, rising by 1.8% in April compared to March. This increase is likely due to higher food and beverage prices, which rose by 3.3% during the same period. Despite the drop in annual inflation rate, Egypt continues to face challenges in controlling inflation, which has remained elevated since 2016. Government has implemented several measures to curb inflation, including reducing subsidies and implementing fiscal reforms, but the effects of these measures have been limited. And Kenya's finance bill has left out alcohol and cigarettes for the excise duty adjustment for the first time in 5 years, offering a major relief to manufacturers and consumers. The two products had become easy targets for excise tax increases as the government sought to raise additional revenues. The move comes on the back of intense lobbying by manufacturers, who warned that higher taxes would lead to lower revenues while resulting in a spike in illicit trade. In addition, the government plans to scrap annual excise rate adjustments that trigger price increases on petroleum products, alcoholic beverages, cigarettes, bottled water, fruit juices, motorcycles, and confectioneries. In a recent development, the International Monetary Fund advised Zimbabwe not to adopt a gold-backed digital currency to address macroeconomic issues such as volatility in the local currency. Instead, the IMF recommends that Zimbabwe should liberalize its foreign exchange market. However, the country's central bank has gone ahead to begin selling digital tokens to reduce the demand for US dollars, which is currently the preferred currency for transactions. The tokens are available for purchase by individuals for a minimum price of $10 and by corporations and other entities for a minimum price of $5,000 and will eventually be used for transactions. Despite this move, the central bank, the IMF, has reiterated that Zimbabwe should use conventional measures such as maintaining tight monetary policy and accelerating the liberalization of the foreign currency market. And that's it on Business Incorporated. Thank you for watching. I'm Ladi Williams. Bye for now.